Hi, everybody. Welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a very special guest here with us, Reed Goosens. And Reed actually is his own podcast host. He hosts Investing in the U.S. podcast. It's one of the top real estate podcasts on iTunes. And in 2012, actually, Reed was able to quit his job in Australia and moved halfway across the globe to the U.S. to basically change his life, and didn't really have much funds at the time, no investing experience, not a lot of credit, and kind of similar to myself, started out in terms of buying very small with the duplex starting out, and then eventually grow his own real estate firm called Wildhorn Capital, which we'll talk about now. And, really what we're going to focus on today is we're hopefully coming out of the COVID-19 crisis in the U.S. And, we want to talk about Reed's experience through COVID-19 with his assets and how he was able to mitigate some risks. And he just mentioned to me before the show, he's preparing his quarterly reports for his investors and want to hear some the numbers behind them. And just to hear Reed's outlook on if he's still bullish on the U.S. multifamily kind of workforce segment as a whole, when we come out of this crisis and even during it and how it's performed. So, Reed, I appreciate you coming on my show here today.
Mate, thank you so much for having me. I'm looking forward to diving into the nuts and bolts.
Sure. Great. So did I do your intro with justice? Or
yes, you did. You did a fantastic job. Thank you so much. It is, I keep hearing that introduction over and over again.
Nice. So Reed, why don't you tell us what you do at Wildhorn, how many units you own, what markets you're buying?
Sure.
Have you been buying? And if you're not buying, what did you buy before and how are they performing right now? Let's kind of just dive through it.
So I'm the co-founder of Wildhorn Capital with my business partner, Andrew Campbell. We buy in Central Texas, predominantly in Austin. We do have some assets in San Antonio. We are still buying. We just closed on a deal just before COVID in sort of the closest deal we have to downtown Austin in the path of progress. We have just around 2,000 units, about $250 million assets under management, I should say. And my role in the business is really focused on the operations and systems. And my background is actually in structural engineering. And so I bring a very institutional level of systems and processes. I've spent many years working on ground up developments, both here in LA and across the globe. And I do definitely bring a different type of perspective to the team between Andrew and myself. Being international, Andrew is from born and bred in Austin. He loves Austin. I have my superpower is the fact that I know what I can't get in Australia, right? I can get it here. So there's just different things that I can see in terms of opportunities. Maybe the average American can't see because they've got their blinkers on. So part of my whole shtick is that, if I can do it, coming half across the globe and 8 years later and achieve financial freedom in the interim, then so can the average American. So yeah.
That's awesome. So can you kind of talk about how you started a little bit and where it's a very high unit count. Talk about how that transition was for you. And then
Sure.
I guess kind of get into the nitty gritty in terms of during the crisis, the performance of the properties and what you guys have been able to achieve.
Yep. So, started out buying, I moved to New York City, didn't have a job, had to pound the pavements until I got one as a structural engineer, and quickly realized that I wanted, before coming to the United States, I had been bitten by the real estate bug, but had not actually executed anything. And when I first moved here, I didn't have any credit or the banks weren't lending to me, but I quickly realized how low the barriers of entry were into some real estate markets, like secondary and tertiary markets. And I saw these very cheap properties for less than $50,000, and I used all cash that I'd saved up from working as an engineer in Australia, and I bought my first triplex for $38,000 back in 2012, 6 months after coming fresh off the boat from Australia. So that was the start of it. And through that, over the years, I got more confident at a few flips, and then I got mentors and co-GP to those mentors, rode on their coattails. And then I eventually, from a professional point of view, I made a pivot from being a structural engineer, and I got a job here in Los Angeles working with a big developer, and realizing that if I needed to, for me to stay in the country, I needed a visa, so I needed an employer for a period of time until I got married. And for about 3.5, 4 years, I was working for a big developer in Long Beach, building high-end multifamily. So really, my experience in the institutional world has come, well over a decade, from structural engineering in London and the 2012 Olympic Games, all the way through to working in New York, Australia, Los Angeles. And then in 2017, when I finally got married, I was able to make the jump to being, with Wildhorn full time. And I was still doing deals on the side that entire time from 2012, but it wasn't until I, got the green card and got enough passive income coming in to replace my current income. And that's when I could go full time. So definitely have had the complete array of, for those people listening out there, grinding, working 2 jobs, trying to make, a side hustle into your full-time hustle. And it takes a lot. It takes a lot of toll on your body. It takes a toll on your relationships, but I eventually got there. And now we're running at full speed, and we're about to buy, as I said, we just closed on a deal in March, and we're about to buy an opportunity zone deal, our first brand new ground up construction deal coming here towards between now and the end of the year. So yeah, that's really in a nutshell the evolution of what I've achieved over the last 8 years. It's safe to say it has been not through a lot of hard work and a lot of late nights, and still to this day, so trying to create something from nothing can be tough.
Takes a lot of effort. Yeah, I can relate to that. And so can you talk a little bit about the transition to, you mentioned you work for a developer and now you're looking to even develop with Wildhorn, your company. Just kind of talk about how you're able to get to that many units that quickly. I know you mentioned you had kind of a co-GP and a mentor. Can you just kind of talk about the importance of that, and why did you choose, after your structural engineering job, I guess, why did you say, okay, hey, multifamily is the way I want to go. I need to do it on a larger scale. Why did that light bulb go off in your head? Number one, and number two, obviously it's in the US. So you're still here and you didn't go back to Australia. So
right.
We're dealing with the crisis, although it's in Australia as well.
Correct.
The COVID crisis. So I've been curious to hear what your outlook is, just moving forward on some of the opportunities you're looking at.
Well, so I'll answer the first question, which is from a macro point of view. The United States is very much I think the best, and part of what I believe is my superpower is my international perspective. Back to my statement, is the best Western country to invest in for cash flow in commercial assets. So in Australia, we don't actually have large scale multifamily like you do here. We don't have, you couldn't go buy a 250 unit property in Australia. And the reason that is because of the way in which our bank and our financing system is set up. We only have 25 million people on the same land mass as mainland America, excluding Alaska. But we can only inhabit the coastal regions because the rest is just a desert. And so I come from very much a high demand, low supply nature. Because there's only 25 million people, there's only 4 or 5 major banks. We don't have the Freddie and Fannie banks that you have here available in America. Also, we don't have those sort of secondary, tertiary markets. When you have 350 million people and you can inhabit, from California to New York, from Texas to the Canadian border, you generate all these other different little smaller pockets of populations that need to be housed. Coupled with that is the fact that, the financing arms here in America, a quadruple or, 10 times the amount that they have. They can also look at a piece of dirt and say, well, I'm going to value this on the future, NOI that's going to be generated from this property. Where in Australia, if you want to develop a 200 unit building, you have to pre-sell X amount of deals, X amount of spaces off the plans, which is a condominium market. So we have a build to sell market in Australia. We don't have the sophistication from a financing point of view for a build to rent model. So think of the Australian market like LA, San Francisco, New York. Very high appreciation, little cash flow, if any. And again, there are commercial deals in Australia. There are hotels and office buildings and retail, but on the multifamily side, you have apartment buildings and you build condos. You don't build for rent. So yeah, that's why I love the multifamily side. Your second question was about COVID. So COVID, let's put it bluntly. 2008 was an American problem, right? It was wholeheartedly a financial issue based on the predatory lending that was being going on, which came around to the Dodd-Frank era, right? It's spread across the world. Today, we're sitting in a pandemic that is affecting everyone. And it's, rent is due in Australia, rent is due in Canada, rent is due in Europe, rent is due in Africa. There's landlords out there that need rent. There's people out there who don't have jobs. There's people out there who have lost their jobs because of COVID across the world. So this isn't a US problem anymore. It's a global problem, which is interesting in its own self, because I don't want to get too into that, but it definitely has, we're all sort of at the same starting blocks. The second thing is COVID. Up until this point, you mentioned in the introduction, we may be coming through the end of it. Well, not so much, because in Texas, they're thinking about shutting back down again, which is where my properties are. All our leasing centers literally just shut again last week. They opened early May, probably too soon, some would say. But really if I rewind even to late March and how we handled it, the true thing is that we really tried to make sure that this is a people first business, right? Our business does not exist without our tenants. And when this whole pandemic came around, regardless of the political side you're on, there was a lot of fear in the air, uncertainty of what the hell was going on. I'm going to lose my job because of a pandemic. Moving forward, this ain't the first and last pandemic we're going to see, right? As investors, we need to now add this new wrinkle to our assessment, right? But what did we do right as it hit? We made sure we got out in front of it and had good communication with our tenants, which was really important, to make sure that we are there for them, that this is not their fault they lost their job. It is through a pandemic that they lost their job, and we're here to try and help them. And really leading with a people first mentality is super important to making sure how we steady the ship through this second wave. We've got assets in lower, with a higher percentage of hourly service-based industry jobs. And I've just been writing massive reports about that. And those assets have actually been affected a little bit worse than assets who have a larger majority of, white collar jobs. So it has really hit the lower income essential worker section, where people have, there's hourly workers, those paycheck to paycheck type of workers. We have seen in general, but the collections have been well over 90% for all the months. But we have seen one of the biggest things that people don't talk about is collections are great, but if your occupancy is dropped by 7 basis points because the fact is you don't have any traffic coming in, then you might be collecting 95% of 90% occupied, right? But you really were already at 97% occupied, but you dropped because of COVID. A lot of people have been moving and continue to move during this COVID pandemic. We thought in our portfolio that we would see renewals skyrocket. They didn't. They stayed about 50 to 60%, which is typical for our portfolio. So when you have, say, 10 people moving out every month, but you don't have the same traffic coming in, releasing to get heads in beds, then you're going to have a disconnect. And we have definitely seen that in some of our assets across the portfolio. We've seen other assets which have done without a blink of an eye. They've actually grown in revenue in the last quarter than they did the quarter previous, which blows my mind. Now, you look at the demographic of the renters there, they are more used to seeing these virtual tours, right? They're more tech savvy. So understanding who your renter is really important, and what is the demographic within each asset, and it can be really deal to deal. Overall, by a high level point of view, multifamily has done really, really well compared to, say, retail or office buildings or hospitality. And what I'm reading is that, and my personal opinion is that we may see a little bit of an uptick in prices as this continues to go on, and I'll address that in 30 seconds. But I also think we're going to see in the long term a flight of capital coming back into the market of multifamily, because of the fact that as humans, the first two things we need is shelter and food, right? So people want to pay their rental bills. People need somewhere to live. So with that being said, I think there's going to be a lot of coastal institutional investors start looking at inner markets. We've seen in the Austin market that we're starting to compete against a lot different bidders from the coastal regions that have never looked at Austin before. And now they're looking at it with real, salivating in terms of how Austin is coming through this pandemic. So it's going to be, I think that's going to, coupled with the fact that increased competition will keep, cap rates compressed. Also coupled with the fact that I think interest rates are going to still be maintained compressed for the next extended period of time with all the, and then you couple that with quantitative easing, I think our asset class is really, really attractive compared to other commercial asset classes. Now, In saying that, the fact that we're coming into a second wave and our leasing centers are shutting down again, we've got the stimulus up until now. That's all well and good, but it will stop. And when the music stops, who is left standing and who ain't got a chair, right? And that's going to be the biggest point. The longer this drags out, and the more QE that the government needs to keep printing money to keep people in business and keep people employed, will hurt the industry, no matter what the industry is, not just multifamily, but will hurt us from the economy point of view over a longer period of time. I do think it won't be a V-shaped recovery. I think it's going to be more like a U/L. We will come up, but we won't come up as quickly as we went down. But it goes back to my original point of like, this is applying across the entire world. This ain't American problem. And this is where, depending on where you're invested in a certain MSA, how you get out of the gates compared to Sydney or London or Barcelona or Austin or New York or LA or Vancouver, we're all in the same boat together. And that is the only silver lining I can see right now. And the way in which each government has responded to the COVID will be how the economy will rebound. But so a lot was said just then. I'll pause to let you ask some questions, because I probably just spewed a lot onto you.
No, that was great. No, I would have asked you questions that you basically just answered. So that was really interesting. So you mentioned some of the metrics in terms of, renewals, not really upticking as much as you thought. Were there any other metrics for you guys? I mean, vacancy, at least you mentioned, obviously you got some larger units than I do. On a whole, it hasn't really gone down too much, maybe 5 basis points, not even 5 basis points.
So saw in April definitely seems to be the worst month across the portfolio, particularly those assets in an asset that we just bought like 12 months ago, and we're trying to transition the demographic. We have got caught we dropped probably to 88% occupied because people got flighty. We had about 6 or 7 skips. Plus we had a lot of people, we're getting to the point now we're having, rent payment plans, but the problem is that a lot of people are building up this treasure chest of money that is owed that they're never going to be able to get out of from underneath. So coupled with the fact that courts aren't open for evictions, we now have to approach these people and say, hey, you're never going to get out of this $3,000 debt that you now owe over the last 3 months. Give us your keys. We'll forgive your debt. And now we've got a lot of bad debt on our books. We've seen a lot of bad debt on those lower demographic type of assets compared to the other ones that we've got 50-50, but we're also part of our value add strategy is to shift the demographic of each asset. It just depends on where you are in that process when COVID hit, right? So it really all depends on how your business plan is going at that point in time, come mid-March when the sort of world came crumbling down. So yeah.
So are you still issuing rent increases for existing tenants?
So April and May we did not, but we also used it so we implemented a zero rental increase to try and capture more renewals. But here's the thing, right? If you're planning to move in April or March, you would have started planning back in January and February. And that's definitely what we saw from exit plan. Now, we did see a lot of people just come to us and say, hey, I'm going to have an issue, paying rent. And when this first pandemic first hit, we sent out communication to tenants saying, hey, we are here for you. We do have tenant, rental payment schemes that we're going to do and help you try and pay the rent. But in saying that, we had a lot of people came into the offices saying, "Hey, I might have potential to get stuck here." But over time, we've seen that slowly decrease, and we've had maybe 2 to 3% of the whole 2,000 portfolio have a real issue with paying rent and having to sort of relieve the rent or forgive their rent. We probably had on top of that another 2 or 3% of people that just said, here's my keys, I'm not going to be able to afford to just continue living here. Not that they had any bad debt accruing, but they just said, I paid up until now, I've got to leave. So being a real mixed bag. And the hard thing is trying to have those exit communications with tenants, because some people just literally get up and leave throughout the night. Some people just drop off their keys and just say, see you later, and don't have a chance to talk to the property manager. So trying to capture all that data is crucial for us, but also it can be a little bit easier said than done. So yeah.
How about for value add business plans, which I know you focus on value add as well. So if you have vacancies come up, Are you still able to capture the market rents you were getting in March, February?
Yeah, no, that's very, very good. So we are offering pretty much, if you aren't aware of this, particularly at least in our markets, concessions just obviously it just took off. Like we had to offer concessions. We've been offering concessions for the last 3 months. $199 total move-ins, $250 off the first month. We did one of the assets. We bought like 12 or 15 door ring bell things to give away with leases, particularly in April and May, to try and incentivize people to come into the office or lease through virtually, because that's the other big thing is the virtual leasing, and that flick to virtual leasing has been really, really tough on some assets compared to other assets. We've got assets in Austin that have just blink of an eye, nothing's wrong. Sure, but you're now leasing on an app. Great. But we've got stuff in San Antonio, which is a little bit more workforce housing. That has been, they're not as tech savvy. That's been a little bit harder. And again, goes back to those, where were you in the process of turning your rent roll when COVID hit? But to your point, when you have higher move outs, you have more units to turn, not necessarily in renovation, but what's called turning, where you just need to get ready for the next tenant. When you're offering concessions and trying to fill that gap, if you drop to say 88%, then you have more units, you've got more work to do, right? So all of a sudden your rent, repairs and maintenance start going up and you start missing budget on that. So it has when people move out, you think, oh great, I've got the unit back, but you actually then got to go in and fix the unit to make sure it's ready for the next person. So it has a lot of, we've had increasing expenses on those assets where all of a sudden our occupancy took a 4 to 6% hit with skips and move outs. And that's the thing people aren't talking about when they say collections. What are you collecting on? Again, as I said before, you might be collecting on 88%. That's great, but you're only at 88%, where 2 weeks ago you're at 93, because everyone just got up and left because they're scared. You got to think about that type of stuff when that human. This is we're all humans at the end of the day. And we try to, and back to my point I said earlier in the show, is that we are trying to lead with a people first mentality, so people don't get scared and they don't just leave in the middle of the night. And that's what we really want to avoid to doing. Month over month, we're seeing it increase and improve. We have seen some assets drop quite significantly in the NOI with the increased increased expenses and the drop off in revenue. That's been tough, because we also, part of our capturing as much rent as we could, is we also waived all our admin and app fees. We waived all the credit card fees. We waived all the additional ancillary income, which can be quite significant. That's all been waived, right? So your total revenue's gone down, plus the fact that your expenses have gone up and you've got a bit of a hit in occupancy. Then you're starting to okay, well, let's keep hold of our cash, and we've done that. So the quarter Q1 we didn't distribute any money. Q2 will start to distribute some dollars to those assets that are performing better. And some assets in our portfolio won't get a distribution in Q2, but that's okay. They'll get a distribution in Q3. We just need to keep hold of cash right now. And it's better to be safe than sorry, given the fact that we're coming into a second wave. And I've heard Austin is potentially going into a 30-day lockdown again. So that ain't good news for certain assets. And that's where the longer this drags out, the longer it's going to hurt. So wear a mask, wash your hands, and just, it's easy to try, and we need to beat this, and so we can all move forward.
Sure. So I know you don't have a crystal ball. I know we're talking about time frames now. When do you think operations are going to be back to normal? And timely distributions.
It's tough to say. We're coming up to Q2 distributions, and we're distributing, I think, out of the 10 assets, 8 of them we're making a distribution on. We did make a distribution in Q1. We're not catching up Q1's distribution, but we're just starting them again. So there's only 2 assets that aren't, and that's in a portfolio that won't get a distribution this month, or this quarter, I should say. And that's just purely fact that we're halfway through a renovation program, right? We are trying to turn the demographic. We're trying to turn units. We've paused all the renovation because, back to your point before, you only, and people who might not know this, you only get an opportunity to have a bite at the apple once. Someone won't come and pay you a premium. So say if you renovate a unit and you lease it at $10 more than what what the previous rent was, because you're like, oh, I was getting a discount because it's COVID. Well, you ain't come year 2 when that person moves out. You're not going to get $150. It's already been lived in for 12 months, right? You only get one bite of the apple to do that renovated pop. So we've stopped all those renovations. We're only doing heavy turns right now in-house, and we're only making ready units classic units for the new tenants, and just trying to keep the occupancy up. So, and that's across the portfolio. We will start to ease that up as August and September come around, we may do 2 or 3 a month, depending on the asset and where it's located. But it's really important to understand that metric and how you manage those construction dollars, because again, you may think I'm just going to keep renovating. Well, hang on, if you're giving a concession away of 2 weeks free and on a new product, you ain't getting it next year. You ain't getting $150 next year because it's already been lived in.
Sure.
So you got to think about that type of stuff as well as you manage a portfolio.
Yeah, no, we've been thinking about the same things here. Reed, so we're going to dial it back a little bit from the COVID conversation because
Sure.
I'm going to try to wrap it up here a little bit. Can you talk, I forgot to mention in the intro, so Reed actually has 2 books on Amazon. You can get both of them, Investing in the U.S. and Guide to U.S. Real Estate, the 10,000 Miles to the American Dream. Can you kind of talk about your inspiration to write both of them?
Sure. So the first one is literally my podcast turned into a book. So taking existing media, and if anyone follows Gary V, I produce media and content through my podcast. It's been going for now 5 years. And I took all the best episodes and intertwined my story to those sort of different step-by-step chapters, and created Investing in the US, which became another number 1 bestseller last year. It's called Investing in the US, the Ultimate Guide to US Real Estate. And that obviously is named the same as my podcast, which is also called Investing in the US. So that came out last year. And then I've got a second book called 10,000 Miles to the American Dream. And it's actually a collaboration with me and 7 other Australian lads that we've all made the pilgrimage across the ditch. We've seemed to found each other through my podcast. We've become good mates over the years. And we've all achieved financial freedom by investing in different assets in different sectors of the real estate market. I obviously am multifamily, but I talk a lot about personal branding in the book. And we all have a chapter. We've got some other folks in there who invest in mobile home parks, single family flipping. We've got a guy who moved out here to Silicon Valley to start a real estate tech company. So they're all Aussies, but they're all achieved financial freedom by coming to the United States and making that pilgrimage, hence the name 10,000 Miles to the American Dream. So that book literally came out this year, and we just hit number 1 on Amazon, which is really freaking awesome. And actually the first book also just got, the audio book was just released. So if you don't like to read and you want to listen to it, jump over to Audible and check out Investing in the US. And the Audible book for 10,000 Miles will come up here in the next couple of months. We're currently working on it right now.
Awesome. I'm definitely one of those audiobook people, so count me in for that.
Awesome.
So we're going to wrap it up now. I'd love to have you on for longer, but we're almost out of time. What's the best way people can reach out to you, Reed, and find you, learn more about you?
Yeah, the best way is just jump onto my website, which is reedgoossens.com. That's REEDGOOSSENS. The other I'll offer to your listeners, if you're ever coming through LA, you're getting back on a plane again, and you want to come and say hi and break bread, maybe have a beer, just shoot me an email at info, that's INFO at reedgoossens.com. Just give me a month or so heads up, and we'll try and make it happen.
Excellent. So we'll provide a link to Reed's website and his email and his social media platforms in our comment section on our social media, as well as in the iTunes description box on Discovering Multifamily. So Reed, really interesting story. Definitely want to have you back on the show again once we're out of the crisis and see how everybody's adapted after and are going to continue to adapt, throughout the remaining years. So really interesting perspective. Definitely can relate to a lot of it with my assets as well. So awesome. I just really appreciate you coming on, and thanks so much again for coming on our show.
Mate, you do an awesome job. Keep up the great work, and I appreciate sharing a little bit of my knowledge and story with your listeners.
Thank you again, Reed.